In this video, I will discuss 5 banks I analyzed that may have issues similar to Silicon Valley Bank. If you bank with any one of them, or if you have any kind of investment in these banks, you want to pay attention. Hi there, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Subscribe to my YouTube channel and follow my Facebook page to learn how to build wealth through investing. Sorry I wasn't able to post a video last week. I'm still fighting a cold, getting better though. There's a lot to uncover. Significant issues masked by an accounting technicality. Accounting techniques can hide a lot on your balance sheet and income statement, and you have to be careful with your analysis of banks or any company for that matter. I made a video about SVB and how it collapsed. In case you missed it, watch the video here. Here's what happened at SVB. There were huge accumulated unrealized losses because of asset liability mismatch. The bank had over $90 billion in safe treasury and agency-backed securities with long-dated maturities. When the Fed started raising interest rates, these securities began dropping in value. When depositors began withdrawing, SVB had to sell these safe securities at a colossal loss, which led to the dramatic downfall of this massive, trusted bank. Companies get a lot of flexibility in classifying fixed income or debt investment securities. These are your treasuries, bonds, agency-backed securities, and any security with a predictable income stream or payment at maturity. For example, you buy a treasury bill with a par value of $1,000, you know you will receive $1,000 at maturity. Or if it is a treasury bond, you know you will receive steady coupon payments semi-annually and the par value at maturity. There are 3 ways that companies can use to classify these investments depending on the purpose and intent of investments. 1. Held to maturity. 2. Trading or held for trading. And 3. Available for sale. And based on how a company classifies them, the company has the option of how it treats unrealized gains and losses. I hope you can guess where I'm going with this. Companies must mark securities classified as trading immediately to their fair trading value. Let's look at a simple example. Today, a company buys a 4-year bond with a coupon rate of 10%, a par value of $100, and the interest rate today is 3%. For simplicity, I'm assuming the bond makes coupon payments annually. These assumptions translates to a cash inflow of $10 at the end of each of the next 3 years and an inflow of $110 at the end of the 4th year. 110 because you add the par value of 100 and the last coupon payment of $10. To find the value of this bond today, you have to discount future cash flows at this interest rate of 3%. The present value of a future cash flow in period T can be computed by dividing the cash flow by 1 plus the discount rate raised to the power T. That gives me a present value of $9.71 for the first cash flow. Feel free to pause and understand this bond math and ask questions if you don't understand it. The present value of the second cash flow is 9.43. The third cash flow is 9.15 and the fourth cash flow is 97.73. This column shows the formula I used to calculate these present values. If you add all these present values, the bond is priced at $126.02. This bond is priced above par value, trading at a premium. Now let's say 1 year has passed and the company has already received its first cash flow of $10. Once it gets this first coupon payment, $10 will appear as income on the company's income statement. The bond's price will again equal the present value of future cash flows. Let's assume that the interest rate didn't change. The bond is now valued at $119.80 by discounting future cash flows. Conversely, if the interest rate increased to, let's say, 8%, this bond is now valued at $105.15. The bond's value changes with interest rates. When the interest rate increases, the bond value decreases and vice versa. If interest rates had stayed constant, this bond would be valued at $119.80. Because of the rise in the interest rate, there is an unrealized loss of $14.65. It is unrealized because the bond hasn't been sold yet. As soon as this bond is sold, the loss is realized and is reported on the income statement. Good so far? We talked about classifications earlier, correct? Trading, available for sale, and held to maturity. Depending on how this bond is classified, this unrealized loss is reported in different ways. If this bond is classified as a trading security, the company has to now show this bond on the balance sheet at the reduced value of $105.15 and the unrealized loss of $14.65 has to appear on the income statement. If this bond is classified as an available for sale security, the company does not need to report this unrealized loss on the income statement. However, the reduced value of the bond shows up on the balance sheet. Now listen to this. If the bond is classified as a held to maturity security, this unrealized loss does not appear on the income statement, and on the balance sheet, the bond is held at its amortized value of $119.80 as though the interest rate never changed. As long as a company can say that it will hold this security until maturity, it does not have to report unrealized losses, nor does it have to reduce the security value on its balance sheet. All of this accounting treatment is fine as long as the security is in reality going to be held till maturity. If you classify millions of dollars of securities as held to maturity, you don't have to report any unrealized losses. Last year, when interest rates began to rise, many banks reclassified their available for sale securities to, guess what? Held to maturity. And poof, unrealized losses disappear over time. No need to show them on the balance sheet as part of accumulated other comprehensive income or AOCI, and the assets may appear inflated. Before I tell you about the different banks that used this accounting technique, I must tell you that I'm not asking you to make a run on these banks for your deposits. I have banking relationships with at least one of the banks that I'm about to discuss. Silicon Valley Bank had reclassified about $9 billion worth of securities from available for sale to held to maturity in 2021. JP Morgan Chase classified $78.3 billion of available for sale securities to held to maturity securities in 2022. This is on page 55 of JPM's 2022 10K in the notes under the balance sheet. This $78.3 billion is about 12% of the investment securities. Until these securities mature, the bank can keep reducing the AOCI loss number. This Ernst & Young report shows an example of how the balance sheet and income statement are updated over the years following the reclassification. The next bank to do something similar is PNC. PNC transferred $82.7 billion from available for sale to held to maturity, about 60% of PNC's total investment securities. I want to highlight this. Note 3, investment securities from PNC's 10K. See how PNC had about $1 billion held to maturity in 2021? Because of the reclassification, you will see about $95 billion at the end of 2022. That's huge. These AFS securities or available for sale securities are marked to market. If interest rates continue to rise, PNC does not have to reduce the carrying amount for these securities on its balance sheet. And if PNC has to sell securities, you will see these huge losses reflect in the income statement in the future. The next bank is Wells Fargo. In 2022, Wells Fargo transferred $50.1 billion from AFS to HTM or held to maturity in 2022. But then Wells Fargo also classified $23.9 billion from HTM to AFS in January 2023. US Bank Corp transferred $45.1 billion from AFS to HTM, and Truist Bank classified $59.4 billion of their AFS securities portfolio to HTM. Here's a summary of what these 5 banks transferred from AFS to HTM and the reasons they provided. Whatever the reason, to hold these to maturity, to reflect their new intent for these securities, execute upon asset liability management strategies. The question is, are they actually able to hold these securities to maturity? The Fed is on track to continue the interest rate increase. Perhaps a banking crisis will cause a pivot. Who knows? FDIC insurance protects individual investors for up to $250,000 in deposits. The purpose of this video is not to create panic or exaggerate the repercussions of changing accounting strategies. The objective is to educate you on what can hide in a company's financial statements. If you are an investor in individual securities, study a company's financials in detail and not take them at face value. If you find my videos valuable, please share them forward and like this video and subscribe to my channel if you haven't already. All your love keeps me motivated to create great educational content for you. I read every single comment you write, so keep pouring the love. As always, don't forget to be happy, to be kind, and to be your best self. I'll see you in the next video. Bye.